Welcome to the Deep Dive, where we take a stack of dense sources and distill them into the critical insights you need to be truly well-informed. Today, we are immersing ourselves in a highly specific but surprisingly complex sector, the world of swimming pools. We are analyzing Pool Corporation, ticker symbol POOL, the largest wholesale distributor of pool supplies on the planet.
That's right. For you, the listener, our mission is to cut through the noise and reconcile a major financial conflict. You have, on one side, a business with a truly spectacular, durable, economic, a near-monopoly distributor. On the other side, you have a stark, painful, cyclical downturn currently squeezing its earnings. This deep dive will help you understand the long-term potential versus the short-term macroeconomic reality.
And our source today. We've dissected a detailed investment analysis report. It tracks Pool's financials from their, let's face it, unsustainable 2022 pandemic peak, right through to the cautious 2025 trough guidance. It is perhaps the perfect modern case study for analyzing a wide-moat business grappling with challenging macroeconomic cross-currents. Okay, let's unpack this. We start, as always, with the structure. What exactly is the Pool Corp business model, and why is it so indispensable to the industry?
Pool Corp is, it's really the definition of a value-added wholesale distributor. They aren't just moving boxes around. They are solving a massive, time-critical, logistical, and financial problem for an entire industry.
Okay, so what is that central logistical problem they're solving?
It's this fundamental gap between concentration on one end and fragmentation on the other. Look at the supply side first. You have a concentrated group of very large, sophisticated manufacturers, names like Pentair, Zodiac, and Hayward. Big players.
Yeah, familiar names.
Right. And these three alone, they accounted for something like 43% of Pool's total cost of products sold in 2024. They want to make huge volumes efficiently, you know?
Okay, so big suppliers.
Yeah.
But the people actually installing and servicing the pools, they're the opposite of concentrated.
Exactly.
Yeah.
Precisely. On the demand side, you have this highly fragmented customer base, a global network of approximately 125,000 professional trade customers. These are your pool builders, the remodelers, and crucially, the service technicians. Lots of small businesses, often just owner-operated.
And they need stuff now, right, for repairs?
Absolutely. They're dealing with time-sensitive repairs constantly. They can't wait for a centralized factory shipment halfway across the country.
So Pool Corp jumps in as the essential intermediary. They're basically a massive, localized warehouse network for the entire trade.
An indispensable one, yes. They offer immediate local access to an inventory that is, well, it's just colossal. Over 200,000 different products.
200,000 SKUs. Wow.
Yeah, everything from obscure little repair parts to chemicals, massive pumps, filters, you name it. And they provide this through a huge physical network, over 450 sales centers spread across North America, Europe, and Australia.
So kind of like an Amazon fulfillment system, but totally specialized for pool pros.
That's a great analogy. And beyond just the inventory, they also supply critical technical expertise. These guys know pools inside out. Plus marketing support for the little guys, and this is really important for small, cash flow sensitive businesses, access to credit.
Right, that credit piece must be huge for them.
It is.
And the scale itself, the source notes that Pool's physical footprint, those 450 plus sales centers, is bigger than all their direct competitors combined.
Yeah.
There's not just market leadership, that sounds like structural dominance. It gives them leverage that, smaller players just can't touch.
And that dominance, it translates directly into a pretty high floor for their revenue base. Here's the absolute key statistic you need to understand about the company's stability. Approximately 86% of Pool sales in 2024 came from aftermarket activities.
Okay, 86%. So that's maintenance, repairs, remodeling, renovation, basically stuff for existing pools.
Exactly.
So only 14% of sales were linked to the highly volatile new pool construction market. Logically, if 86% is aftermarket sort of recurring revenue, that should cushion them from a downturn almost completely. Yet we know they're struggling right now. So why the discrepancy? What's going on there?
This is the crucial nuance. This is the real learning nugget we pulled from the detailed analysis. That 86% recurring revenue number, it's actually a bit misleading because it is not a single monolithic block of stability. We absolutely have to break it down into two very different types of spending.
Okay. Lay out those two spending flavors for us. What are they?
So the first flavor is genuinely non-discretionary. This is the bedrock floor revenue. We're talking chemicals, basic filters, mandatory leak repairs,
Yep.
the absolute essentials.
Stuff you have to buy if you own a pool.
Right. If you own a pool, you have to buy chlorine, you have to keep the pump running. Doesn't matter if you feel rich or poor that month. The cost of not doing that basic maintenance is, well, your pool turns into a swamp. So this revenue segment is extremely stable, rock solid.
Okay, got it. That covers essential maintenance. What about the other, more volatile slice of that 86%?
Ah, that's the highly discretionary portion. This is the remodel and renovation component. Think replacing the interior plaster finish, which is expensive, or upgrading to a fancy new heating or automation system, or putting in a whole new hardscape deck around the pool.
Right, so it's the equivalent of, say, postponing a big kitchen renovation versus skipping buying groceries. You can delay the big stuff.
Precisely. That distinction is incredibly important. So while the customer must fix a broken pump motor, they can easily defer that $20,000 deck upgrade until, interest rates drop or the economic uncertainty clears up a bit.
Okay, that makes sense.
And management commentary from Q3 2025 actually confirmed this shift in consumer behavior directly. They explicitly stated that consumers are prioritizing essential repairs and targeted improvements rather than large-scale upgrades. That's the quote.
Ah,
So that's why the company is facing revenue pressure much greater than that small 14% new construction exposure would suggest on its own. The cyclicality is hiding in plain sight, really. It's wrapped up inside that big 86% aftermarket number. You can delay a renovation, but you can't delay basic maintenance.
that analysis clarifies the current pain beautifully. It really does.
Yeah.
Okay, even with that short-term cyclicality hitting the renovation side, the long-term structural drivers for the whole industry still look pretty robust, right?
Oh, absolutely. The long-term industry growth framework seems solid. The analysis projects something like 4% to 6% annual growth over the long haul.
And how does that break down?
Well, if you break it down, you see maybe 1% to 2% comes from just general inflation. Another 1% to 2% is structural, that comes from the organic growth, and just the simple aging of the installed pool base. Pools get old.
Right, they need more work over time.
Exactly. And finally, maybe 1% to 2% from new pool additions over the cycle. The core fact is a swimming pool is a depreciating asset. It gets older, it must be maintained, and eventually it must be upgraded or renovated. That's baked in. Hashtag 1.3 seasonality and operational leverage.
Now let's connect this back to the sort of operational reality of running this business day to day. Because the product is so tied to summer and sun, the business must be highly seasonal.
Oh, dramatically so. The primary peak selling season really runs from March through October. That's when everyone's thinking about pools. And this forces an enormous operational requirement on pool. They have to build up significant inventory and secure all their logistical resources during the slow season, so Q4 and Q1, in anticipation of that huge spring and summer rush.
Feels like a massive logistical gamble every single year. You've got to predict demand way in advance.
It really is. They're placing huge bets on inventory levels.
And this whole structure creates that phenomenon we call operational leverage, which sounds like a powerful double-edged sword here. It amplifies the good times, but also the bad.
It truly is a high-stakes lever. Think about it. The vast majority of their operational costs, the leases on those 450-plus sales centers, the salaries for their expert technical sales teams, the base transportation costs, most of that is fixed. They have to pay those costs whether they sell, $100 million or $1 billion worth of stuff in a given quarter.
So when sales volumes are booming, like they were back in 2022 during that crazy pandemic demand, that revenue quickly covers the fixed cost base. And then every incremental dollar sold flows almost directly to the bottom line, right?
Amplifying profitability beautifully.
Correct. Profits soar much faster than sales.
Meh.
But when sales fall short, as we saw in those weak Q1 2025 results, which management partly blamed on unfavorable weather and macro weakness, that same fixed cost base acts like a lead anchor.
If sales drop by, say, 10%, you still owe 100% of those lease payments and those salaries. That negative operational leverage is what really exacerbates the earnings decline. It causes profitability to fall much, much faster than revenue volume.
Ouch. Makes the downturn feel even more visceral for shareholders, I bet.
Definitely. It magnifies the pain on the way down just like it magnifies the gain on the way up.
Okay, that provides a really clear understanding of the mechanics. We see the structure, the seasonal rhythm, and the sort of inherent volatility hiding within that big aftermarket revenue base. Let's move to their structural defense then. The unassailable competitive moat. So the sources we looked at consistently label Pool's economic moat as wide, and unassailable. Now, for a distributor, that's pretty rare praise. We need to really dig into the specific elements that give them this durable competitive advantage. What are the structural advantages that keep rivals effectively locked out?
Yeah.
Hashtag 2.1, the components of the economic moat.
Okay, so the moat really begins with sheer logistical superiority, which, in turn, creates significant switching costs for their customers. The primary advantage is just their network density. Over 450 sales centers, all strategically placed. Now think about that 125,000 strong professional customer base. For them, time is the ultimate constraint. Time is money, literally.
Right. A broken pool pump means an angry homeowner breathing down your neck and the clock is ticking. You need that part yesterday.
Exactly. The pool professional simply cannot afford to wait 2 days for a shipment from the manufacturer or, drive 100 miles to the nearest depot that might have the part. They need that obscure fitting or specific filter now.
And Pool provides that immediate access.
Precisely. Pool ensures that a professional can get their hands on something from that enormous 200,000 item inventory within a very short drive, minimizing their non-billable downtime. Now, replicating this integrated, optimized supply chain and inventory system, that is a massive undertaking. It's incredibly capital intensive, and it requires decades of operational fine-tuning to get right.
So that logistical sophistication effectively locks in the trolled professionals. Makes it hard to switch.
Very hard. It creates a huge convenience barrier.
And that scale doesn't just benefit the customer on the ground. It must give Pure enormous leverage internally with their suppliers, too.
Oh, absolutely. It grants them significant purchasing power. Remember, those top 3 manufacturers, Pentair, Zodiac, Hayward, they account for 43% of Pool's product costs. Pool is by far their single biggest distribution channel globally. This scale grants them highly favorable terms, better discounts, and critically, priority access to inventory, especially during periods of supply constraint like we saw post-COVID.
Right, getting allocation when things are tight.
Exactly. No smaller competitor can possibly negotiate on those kinds of terms or command that kind of priority.
Okay, so if the moat is truly that strong, we should see some hard evidence of their ability to control their own destiny, particularly around pricing. Can they raise prices even when demand is soft?
And we do see that. This is a really powerful signal from the analysis. Despite the overall challenging inflation and the soft demand environment recently, Pool demonstrated remarkable pricing power. Get this. In Q3 2025, they actually expanded their gross margin.
Wait, expanded margins in a downturn? That's counterintuitive. How?
The analysis explicitly attributed this, in part, to mid-season price increases and successful pricing optimization initiatives. The very fact that they can push through price increases and actually improve their gross margin, even when customers are clearly pulling back on volume for bigger projects, that is the clearest possible indicator of a wide functional economic moat.
It suggests customers don't really have effective competitive alternatives, at least not for the whole package Pool provides.
Pretty much. They might find a part cheaper somewhere else occasionally, but the convenience, breadth, and reliability are hard to beat. Hashtag 2.2, the barrier to entry distinction.
Okay, here's something that often confuses people when looking at distribution companies, and it came up in the source material. Pool's own 10K filing, their official document, states that the technical barriers to entry in the distribution industry are relatively low. So if the technical barrier is low, how can the moat possibly be unassailable? That sounds like a contradiction.
Yeah, it does sound like one, but this is a vital conceptual distinction to grasp. And it really goes to the heart of what makes Pool so special. Technically, yes, it's true. Anyone with, moderate capital could probably lease a small warehouse somewhere, buy some basic inventory, and start up Sam's Pool Supply in a single town. That's the low technical barrier they're referring to.
Okay, but the practical barrier to actually competing with Pool at any meaningful scale, that's what truly matters here.
That is exceptionally, incredibly high. Competing effectively doesn't mean having one little store. It means replicating that 450-plus national network. And to do that, you need immense patient capital. Just think about the hurdles involved. You'd need to acquire favorable real estate and navigate complex zoning laws in 450 distinct municipalities. You'd have to set up the incredibly complex integrated IT and logistics infrastructure needed to manage inventory across that network. You'd need to establish strong distribution agreements with those concentrated manufacturers who already have a great relationship with Pool. And maybe most difficultly, you'd have to build the brand equity and trust with those 125,000 fragmented professionals, something Pool has done over decades.
So a regional competitor might pop up here and there, but replicating the national footprint that offers that consistent, unparalleled convenience and sheer depth of product across the entire Sunbelt and beyond, that's the practical impossibility.
It really is. It's an infrastructure challenge that would take billions and billions of dollars and many, many years of flawless execution to even attempt. And any new entrant trying would face absolutely crushing negative operational leverage for probably the first decade, just trying to build enough volume to cover that massive fixed asset base.
Okay, that makes sense. It's the scale and integration that create the real barrier.
Exactly. That practical, scale-driven barrier is why analysts confidently assign Pool that wide economic moat status, despite the technically low barrier to opening one shop, hashtag tag 2.3 expansion into outdoor living.
Now, Pool isn't just sitting still, satisfied with only owning the edge of the swimming pool. They seem to be strategically leveraging that powerful distribution network to move into the broader outdoor living market.
Yeah, this looks like a brilliant strategic move, honestly, because it utilizes their existing, largely fixed cost distribution infrastructure, the trucks, the warehouses, the sales teams, to carry complementary, often higher margin product lines.
So they can sell more stuff to the same customers using the same routes.
Pretty much. It's a way to increase the lifetime value of their existing trade professional relationships and sweat those fixed assets harder.
Makes sense. Which are the key initiatives driving this expansion? What are they selling beyond pool parts?
There are really two main buckets highlighted in the analysis. First, there is Horizon. Horizon focuses on irrigation and landscape maintenance supplies, sprinklers, lighting, tools, that kind of thing.
That sounds like a very natural fit for their logistics network and their customer base, like landscapers who might also do some pool work.
It is a very natural fit. The second main initiative is NPT. NPT stands for National Pool Trends, but it was formerly known just as National Pool Tile.
Ah, NPT. And that's where they move into the really discretionary, potentially higher margin materials, right? Like the fancy stuff.
Exactly. NPT focuses on hardscapes, pavers, stone, also decking materials, and those beautiful interior pool surfacing products like pebble finishes. Now, while this definitely offers significant growth potential when consumers are feeling flush and remodeling, management has also noted that MPT products are highly sensitive to external market factors.
Because it's purely discretionary spending.
Right. Because a homeowner can easily postpone buying expensive new deck tiles or redoing their whole patio, NTT actually acts as a greater headwind during the current cyclical trough than the core pool maintenance business does.
So high reward, but also higher volatility depending on the economic cycle.
Precisely.
Yeah.
But it underscores their long-term commitment to capturing a much larger share of the overall backyard wallet, not just the pool itself.
Okay, so we've established the structural advantages, the wide moat. Now let's pivot directly to the immediate problem. The financial impact of this cyclical downturn since that unbelievable pandemic boom. We need to look at the actual numbers to understand the severity of this normalization they're going through. Hashtag tag 3.1, the post-COVID normalization, peak to trough.
Yeah. The post-pandemic environment created this massive, frankly, artificial pull forward of demand that was just never going to be sustainable. And we can see the stark reality reflected right there in the financial summary table from the report. Net sales peaked back in 2022 at $6.2 billion, $6,211.9 million to be exact. But more critically for investors, diluted earnings per share, EPS, peaked at a staggering $18.70 that same year.
$18.70 EPS. That was clearly an exceptional temporary peak driven by everyone being stuck at home wanting a pool. Where did it fall to during this normalization period?
Well, the descent was pretty rapid. Both sales and EPS declined sharply through 2023. By the time we get the full numbers for 2024, net sales were down nearly $500 million from that peak. And EPS, it had plummeted all the way down to $11.30.
Wow, from $18.70 down to $11.30. That is a massive haircut to profitability in just 2 years.
It really is a huge reset.
And the latest 2025 guidance seems to confirm that we are now stabilizing or maybe bottoming out at this new lower financial base. Is that the trough confirmation?
That's exactly what it looks like. That's our confirmation point. Management's guidance for the full year 2025 projects EPS in a pretty tight range, from $10.81 up to $11.31. And they expect sales to be, quote, relatively flat to up slightly.
Flat to slightly up, off the low 2024 base.
Correct. They are essentially projecting zero meaningful growth off that low base set in 2024. So this signals that, yeah, the sharp correction phase is likely over, but the period of robust recovery, that definitely hasn't begun yet. They seem kind of stuck in the trough for now.
That drop, $18.70 down to around $11, it just powerfully highlights the sensitivity of this business to the discretionary spending cycle, even with that famous wide moat.
It absolutely does. The moat protects their market share and their profitability relative to any potential competitors, but it does not and cannot protect the company from the wider macroeconomic gravity when consumers pull back. Hashtag TAG 3.2 macroeconomic headwinds and management commentary.
Now, when you read through the management commentary provided in the source over the last couple of years, one factor consistently emerges as the primary culprit for this demand destruction, particularly for those big, expensive, discretionary projects. What is it?
It's overwhelmingly the persistently high interest rate environment. Management has repeatedly, almost in every quarterly call, cited high rates as directly causing a wait-and-see pattern among consumers.
And why is that? What's the direct link?
Well, think about it. Those large renovation projects or brand new pool construction, they often require consumers to take out loans, maybe a home equity line of credit, HELOC, right?
Sure, big-ticket items.
And the high cost of servicing that debt right now just freezes the decision-making process for many households. Consumers simply defer the project until rates become more palatable or until they feel more certain about the economy.
So it's a direct financial roadblock for those big-dollar projects. And it isn't just interest rates acting as a headwind, right? The broader housing market health plays a big role, too.
Yes, absolutely. Reduced housing turnover, fewer people selling their homes and buying new ones removes a really critical renovation catalyst.
How so?
Because new homeowners are historically a huge driver of renovation and upgrade demand. You buy a new house, you want to make it your own, maybe put in that pool you always wanted, or fix up the old one.
Right. If people aren't moving, they just live with the old patio.
Exactly. If people stay put, that urgency to renovate often fades. And then you just layer on top of that the effect of general inflation across the board, cost of groceries, gas, everything else. It constrains household budgets, eating into the disposable income that might otherwise have been earmarked for a backyard upgrade, even if they weren't borrowing.
Okay, so multiple pressures. Let's track the recent history, just within 2025. Does the quarterly progression give us any indication of when this trough might actually turn into a recovery?
Well, Q1 of 2025 was definitely the worst of the recent period. They showed a 4% year-over-year revenue decline. Management blamed both genuinely poor weather in some key markets and the macro environment. However, we did see some stabilization in Q2 and Q3 of 2025. Both quarters reported modest, very modest, 1% year-over-year revenue growth.
Okay, only 1%, but growth is growth, I guess. Is that meaningful?
It is meaningful in the sense that it suggests the sharp period of contraction, the sort of panic selling and destocking maybe, is likely complete. It feels like we're currently bumping along the bottom, maybe forming a base, but certainly no sign of a V-shaped recovery yet. Hashtag TAG 3.3 profitability and margin contraction.
And with sales volumes falling against that largely fixed cost structure we talked about, margin contraction is inevitable. But the severity of the drop here seems pretty notable.
It really is significant. We saw substantial moderation or compression from those heady 2022 peaks. Gross margin fell from a peak of 34.8% in 2022 down to 32.3% in 2024. That's painful enough.
Okay, 250 basis points off the gross margin.
But the operating margin dropped even more sharply. It went from 15.8% all the way down to 10.7% over the same two-year period.
Wow, that's a 500-plus basis point drop in operating margin.
Yeah.
That perfectly illustrates the inverse power of that negative operational leverage we discussed earlier.
Precisely. Those fixed costs, the leases and salaries, suddenly represent a much larger percentage of the lower revenue base. That's negative deleverage hitting hard. But we also had that second factor we touched on, the product mix shift.
Right, people deferring the fancy stuff.
Exactly. Since those high-margin, large-scale renovation projects, think the NPT materials, the expensive upgrades were being deferred disproportionately, the overall revenue mix shifted more towards the lower margin, essential maintenance items like chemicals and basic parts. That unfavorable mix shift further compressed the overall margins on top of the volume decline.
Okay, so it's a double whammy on margins. But despite those brutal margin cuts, the analysis suggests the fundamental financial quality of the business seems to be holding up remarkably well, doesn't it?
That's the moat doing its job, protecting the underlying profitability engine. Even after suffering that negative operational leverage and the unfavorable mix shift, the return on equity, ROE, in 2024 remained exceptionally high at 39.4%.
39% ROE in a trough year. That's still incredibly strong.
It's phenomenal. For a cyclical business deep in a downturn, maintaining that level of capital efficiency is a powerful testament to the structural quality and resilience of PoolCorp's business model. It tells you it remains a fantastic core asset, even if the current earnings are temporarily depressed by the cycle.
Okay, understanding that very high ROE, even in a downturn, the next logical question is how this distribution powerhouse generates and then deploys its cash. Let's look at its capital structure and cash flow. Hashtag tax tag 4.1 cash generation and efficiency.
Yeah, a major factor contributing to that high ROE is that this is fundamentally not a capital-intensive business model. They are distributors, moving products, they're not building semiconductor fabs or anything. If we look at their capital expenditures, CapEx, as a percentage of their cash from operations, CFO, between 2022 and 2024, it averaged a remarkably low 12% to 16%.
Only 12–16% of operating cash flow going back into CapEx. That low capital requirement is a huge structural advantage over, say, a heavy manufacturing company or a tech company needing constant R&D investment. It means a vast proportion of their operating cash flow converts directly into free cash flow, money they can actually return to shareholders or reinvest.
It makes them a potential cash printing machine when the cycle is favorable. Even in a down year like 2024, they generated $569.2 million in free cash flow. That's still a lot of cash.
We should probably also briefly touch on the quality of those earnings. Is
Sure.
the cash flow tracking the reported net income reasonably well? Because cash is what ultimately matters, not just accounting profit.
Yeah, the earnings quality looks robust overall, though you do see some natural volatility tied primarily to working capital management. In 2024, for instance, cash from operations, which was $651.1 million, was actually significantly higher than the reported net income of $434.3 million.
Why the big difference there?
The source clarifies this difference was mainly due to active inventory reduction efforts that year. As demand softened, they deliberately worked down their inventory levels. When they reduce inventory, it frees up cash that was tied up, boosting CFO relative to net income for that period.
Okay. And conversely, in the boom years, when they were rapidly building inventory to meet demand, CFO probably lagged net income.
Exactly. It's a normal sign of disciplined management of their working capital cycle, responding to demand fluctuations. It doesn't look like an earnings quality issue.
Got it. Finally, on the asset side of the balance sheet, let's consider the assets that aren't maybe fully recognized by traditional accounting standards.
Right. The balance sheet does show substantial tangible assets, obviously, and it also shows, as of 2024, about $699 million in goodwill and $291 million in intangibles, likely related to all those past acquisitions they've made. However, the company's single most significant unrecognized asset, the one that really drives its premium valuation in the market, is that integrated distribution network itself. It's those deep, enduring supplier relationships and the locked-in loyalty of that massive customer base. Accounting rules simply cannot capture the full economic value of that competitive moat. It's worth far more than what's on the books. Hashtag tag 4.2 capital allocation priorities.
Okay, so they are generating immense free cash flow, even in a down cycle like 2024. What is management's stated philosophy for deploying all that capital? What are their priorities?
Their stated mission pretty clearly guides their allocation strategy: to create exceptional return for our shareholders. Pretty standard stuff. And this is generally achieved through a structured priority list. First, reinvesting for organic growth in the core business. Second, making strategic acquisitions. Third, paying dividends. And fourth, executing share repurchases.
The dividends in particular seem to speak volumes about their consistency and the underlying confidence in that recurring revenue floor from maintenance.
Oh, absolutely. They have paid a consistent quarterly dividend every single quarter since way back in 2004. That's a 2-decade track record through multiple economic cycles. And perhaps even more telling, even right in the middle of this current downturn, they announced another 4% increase to the quarterly dividend in April 2025.
Raising the dividend now, that's a strong signal.
It's a very
And their acquisition strategy, you mentioned it's a priority. It seems focused on density rather than just getting bigger for bigger's sake, right?
Yes, it's generally been a very disciplined strategy of tuck-in acquisitions. These are typically smaller deals designed to increase their network density within existing geographic markets or maybe enter immediately adjacent ones. Fill in the map, basically.
And they're continuing this even now, during the trough.
They are. The analysis notes recent examples like Vegas Stone Brokers, that's a hardscape specialist, fitting with the NTT strategy acquired in October 2025, and also Great Plains Supply, another regional distributor, bought in August 2025. This shows they are proactively using the cyclical trough, when valuations might be lower, to deploy capital strategically and strengthen their network, perhaps picking up smaller regional players who might be struggling more in the downturn. Hashtag 4.3, critiquing share repurchase timing.
Okay, this brings us to a really crucial point of managerial execution and, frankly, a financial critique that was highlighted quite clearly in the analysis: the timing of their share repurchases. While buybacks are stated as part of their core capital return strategy, the actual capital discipline displayed back during the peak years seems questionable.
Yeah, this is a critical discussion point if you're evaluating management effectiveness and governance. Pool Corp spent an absolutely astonishing amount on share buybacks back in 2022, over $1.06 billion.
Over $1 billion in 1 year on buybacks. How does that compare to other years?
For context, they spent less than half that amount combined in the two subsequent years, 2023 and 2024. So 2022 was a massive outlier.
Wait a minute. We just established that $18.70 EPS in 2022 was the absolute peak of the cycle earnings. We know 2022 is the peak year. So that means management was aggressively, very aggressively, buying back shares when the stock was trading near its all-time high valuation, just before the sharp cyclical decline hammered the stock price.
That is exactly correct. They deployed a substantial portion of shareholder capital, over $1 billion, at pretty much the highest point in the business cycle, and likely the highest average valuation the stock will see for quite some time.
That seems like less than optimal capital allocation timing, to put it mildly.
It really does. Objectively, it raises an important question for investors evaluating any company. What signal does it send when management, the insiders who theoretically have the deepest operational insight into the business trends, are buying back stock hand over fist right at the cyclical peak?
Was it just hubris? Did they think the good times would last forever? Or simply a gross misread of how quickly and sharply the macro environment would normalize post-pandemic?
The analysis leans towards the latter. It suggests it was likely a failure to properly factor in the short-term, clearly unsustainable nature of that pandemic demand boom. They seem to have treated those peak earnings as if they were the new normal when deciding how much capital to deploy on buybacks at those high prices.
So while the strategy of returning capital via buybacks is sound in principle,
Right, nothing wrong with buybacks generally.
the execution timing here appears to have severely impaired the long-term value creation or benefit of that specific billion-dollar allocation. It bought fewer shares at a higher price than if they'd waited or spread it out.
Precisely. It's a tangible example that every learner should reflect on when judging not just the strategy, but the execution quality of corporate governance and capital allocation decisions. Timing matters. A lot.
Okay, we've established the moat, we've analyzed the pain of the trough, and we've looked at their capital strategy, including that poorly timed buyback.
Yeah.
Let's pivot firmly to the future now. What are the key long-term growth initiatives that Pool is counting on to propel them out of this current rut and get back to growth? Hashtag 5.1, long-term growth initiatives and tailwinds.
Well, internally, Pool is consistently targeting about 2% to 3% annual growth, just from what they call Pool actions. This basically means continuing to gain market share organically within their existing markets and supplementing that with those small, density-focused tuck-in acquisitions we discussed. And given how highly fragmented the professional customer base still is in many regions, that runway for consolidation and share gain probably remains quite long.
They also have the longer-term option of international expansion, right? Primarily in Europe and Australia, where they already have a foothold.
They do. That represents a potentially significant long-term runway for growth. But as we saw with the recent commentary about sales pressure in France, apparently due to some political strain there, international operations definitely introduce new layers of macroeconomic risk, geopolitical risk, currency fluctuations. It's more complex.
That's the trade-off for growth, I suppose.
It is. But perhaps the most promising internal growth driver highlighted right now is their significant investment in technology, specifically their B2B digital platform called Pool 360.
Okay, Pool 360. Tell us more about that. How is a digital platform actually driving market share gains for a distributor? Is it really working?
It seems to be. Pool 360 is fundamentally changing how pool professionals interact with pool day to day. It provides easy online ordering, 24/7 real-time inventory checks at their local branch, access to technical resources and diagrams, essentially digitizing the entire relationship. And we have some hard evidence of its success presented in the analysis. Transactions made through the Pool 360 platform accounted for 17% of Pool's total net sales in Q2 of 2025.
17% already. That's pretty significant adoption.
It is, and this rapid adoption drives massive internal efficiency for Pool, lowering transaction costs. But crucially, it also creates digital stickiness with the customer. Professionals who integrate Pool 360 into their daily workflow, ordering parts from the job site on their tablet, for example, are far less likely to switch to a smaller, less technologically advanced competitor, even for a slightly lower price on one item. It becomes embedded.
Makes sense.
Yeah.
Raises switching costs again. Okay, so those are internal initiatives. Beyond their own actions, they also have some powerful demographic and structural trends acting as natural tailwinds behind them.
They do. The two biggest are probably geographical migration and simply age. First, there's the ongoing, well-documented demographic shift of population towards the Sunbelt states, places like Arizona, Texas, Florida. That's where pool ownership density is highest, so that migration provides an organic, steadily growing installed base of pools needing service.
Or pools in the right place.
Exactly. Second, and maybe even more impactful long-term, is the simple aging of the existing pool infrastructure across the country. The massive number of pools that were built 15, 20, 25 years ago during previous housing booms are now hitting a critical point in their life cycle where mandatory renovation and major equipment upgrades become necessary, not just discretionary.
Things just wear out.
Things wear out. Liners tear, plaster cracks, pumps die. That feeds directly into that resilient 86% aftermarket business for decades to come. It's a built-in replacement cycle.
Okay, now we inevitably come to the great debate, the real challenge perhaps at the heart of analyzing this company right now. Valuation. Pool is clearly a blue-chip, high-quality company, and as such, the analysis shows it consistently commands a premium valuation compared to its more generic industrial distribution peers.
Yeah, the premium is pretty staggering, actually. If you look at the broader industrial distribution sector, companies that might have similar logistical structures but lack pool specialization, market dominance, and clear moat, they typically trade in a range of maybe 6.0x to 13.0x EBITDA. Somewhere in there.
Okay, 6x to 13x for typical distributors. Where does Pool trade?
Pool, reflecting the market's deep trust in its quality and resilience, consistently trades around 18.5x EBITDA, according to the report. That's a huge premium.
Why such a big gap?
Investors are willing to pay that premium because they believe Pool's earnings are safer, more resilient due to the aftermarket base, and ultimately more likely to grow consistently over the very long term compared to a more cyclical, commodity-like distributor.
Okay, so it gets a premium multiple. Now let's apply that multiple thinking to the current depressed earnings level. The report mentioned that as of October 2025, the price-to-earnings PE ratio was sitting around 27.0x.
Correct. 27 times earnings.
Now, that PE of 27x is actually slightly below its own 10-year average PE, which was closer to 28.6x.
Yeah.
But it's still incredibly high for a company whose earnings are currently sitting at a cyclical low point, right? It's certainly far, far above the absolute cyclical low PE the stock hit, which the report noted was around 16.0x back in late 2022 when pessimism peaked.
Right, and this framing highlights the core valuation dilemma for you as a learner right now. What is the normalized earnings power of this business coming out of the trough? We know the absolute peak was at $18.70 EPS in 2022. We know that a trough guidance for 2025 is centered around $11, $10.81 to $11.31 midpoint. The stock price today is effectively using a premium PE multiple, that 27x, and applying it directly to those trough-level earnings.
So let me get this straight. Paying 27 times trough earnings means the market isn't waiting for the recovery. It's already factoring in, and essentially buying, a massive future earnings recovery today. It's not cheap based on current results at all.
It absolutely is not cheap on current earnings. That's the key insight. The market is basically sending a signal saying, we believe the true normalized EPS power of this business, once the cycle turns, is likely much higher, maybe closer to $16 or $17, and we are willing to pay today's premium multiple based on those expected future earnings, not today's depressed earnings.
Okay, so the risk then is, what if that recovery takes longer than the market expects? Say interest rates stay high and the rebound doesn't really kick in until 2027 instead of maybe 2026. Or what if the new normalized earnings base post-cycle actually settles out a bit lower than the previous peak, maybe due to structural changes?
Exactly. If either of those things happens, a slower recovery or a lower normalized earnings ceiling, then the current valuation premium becomes very, very hard to justify. You are essentially paying a high price today for a high degree of certainty about both the timing and the magnitude of the eventual recovery. That's the bet embedded in the current stock price. Hashtag 5.3 risks and key monitoring indicators.
Okay, that frames the valuation challenge perfectly.
Yeah.
Before we conclude, let's quickly synthesize the primary risks still facing the business, and maybe more importantly, provide the listener with the key metrics they should be monitoring going forward for signs of that recovery, or perhaps signs of further trouble.
Sure. The external risks, the macro risks, remain the most powerful and largely out of the company's direct control. We absolutely must continue to monitor for the possibility of a prolonged global recession, which would hit discretionary spending hard. Persistently high interest rates that continue to choke off that critical renovation financing, a potentially severe housing market downturn that removes the new owner renovation catalyst. And of course, you always have the wild card of unpredictable weather patterns that can significantly impact sales volumes during their peak spring and summer selling seasons. A rainy spring can really hurt Q2.
Okay, those are the big external ones. Internally, we have to come back to that significant supplier concentration, right? The top three making up 43% of product costs.
That concentration absolutely introduces significant latent risk. What if one of those key suppliers, say a Pentair or a Hayward, decided to seriously experiment with the direct-to-consumer or direct-to-prey model for certain product lines, maybe bypassing Pool entirely? Now, Pool's network density makes this very unlikely for their entire product range, especially for bulky items or immediate repair parts. But a strategic shift by even one major manufacturer towards more direct selling could potentially impact Pool's margins or supply continuity over time. It's a risk to watch.
And acquisition risk.
And yes, integration risk is always present with any acquisition strategy, even if there are mostly smaller tuck-ins. Ensuring the acquired company culture fits and the expected synergies materialize isn't guaranteed.
Okay, so for the listener who wants to actively track Pool's recovery from this trough quarter to quarter, what are the critical metrics they should really zoom in on in the earnings reports?
I'd say focus on 4 key things. First, organic sales growth, specifically in the most discretionary categories. Take close attention to the NPT segment, the hardscapes and decking and maybe building materials. When that growth turns meaningfully positive year over year, it's a strong signal consumer confidence for big projects is returning. Second, closely monitor gross and operating margins. A reversal of the recent contraction trend, seeing margins begin to expand again, will signal that their pricing power is firming up and that negative operational leverage is starting to unwind. That's crucial for earnings leverage. Third, keep an eye on broader new pool construction data from industry sources. That's your best forward-looking indicator for the most cyclical part of their business, even if it's only 14% of sales. And finally, watch their reported inventory levels relative to sales. Disciplined inventory management is absolutely key to their cash flow generation. Seeing inventory levels stay lean or track sales appropriately shows management is accurately reading future demand and not getting caught overstocked again. Hashtag tag out.
We have definitely completed our deep dive into Pool Corporation. The risk-reward profile seems complex, but it's clearly balanced around that incredibly powerful, durable economic moat.
Yeah, you've got the downside pretty firmly cushioned by that resilient, largely non-discretionary maintenance business.
Yeah.
That provides a high revenue floor, minimizing the risk of a truly catastrophic collapse. But the upside, that's where the real leverage is. It's tied directly to the inevitable eventual cyclical recovery in discretionary consumer spending and the housing market, which fuels that high-margin renovation segment.
It really strikes me as a phenomenal business. Fundamentally, it's just currently caught in some pretty significant macroeconomic turbulence.
Exactly. And I think given that the company's stock price, with its premium multiple, currently anticipates a significant cyclical upswing already, the central consideration for you, the listener, isn't really if the pool industry will recover. The demographic trends, the aging pool base, they pretty much ensure it will recover eventually. The real question you need to wrestle with is whether the timing of that recovery will be fast enough and whether the new normalized peak earnings level reached post-recovery will be high enough to actually justify paying the substantial historical premium that pool continues to command, even while it's standing firmly in a cyclical trough today.
That framing provides the perfect lens for future monitoring and analysis. A great place to leave it. That's all the time we have for this deep dive. We'll catch you next time.